session. Is everybody ready for the economic debate? Do we have Vladimir and we do? So all the participants, Marcus and everybody else. So if you'd kind of come and Hannah, yes, there we come. Okay, so if you guys would kind of come and take your places up here, please. Thanks, guys. Yes, please. Okay, so good morning. I'll hand over the introductions to Vladimir, so I'll clear out. It's all yours, pal. So thank you, sir. All right. Good morning. Okay.
Okay. Dobré jutro, jó reggelt kívánok. Dzień dobry. Guten Morgen. Guten Morgen.
Really good.
This panel has a very complicated description, but basically what we will do, we're gonna read a crystal ball. Do I own a crystal ball? I sell them actually. No, I'm kidding. But that's the reason why Mark put me on the panel with a highly distinguished group of experts, not only in macroeconomics, but also in what you nastily call O2C. I call your industry knowing whom to trust. So I'm a passionate macroeconomist, but as I like to say, I'm an aspiring junior credit manager because I would love to do what you, or know what you do. So to discuss these intricacies of the current macroeconomic developments and what they do mean for your industry and for your job in particular, I'm joined by a very distinguished panel of 4 speakers. I don't let them introduce themselves. I've learned this from the credit industry. You are supposed to know who you talk to. So first of all, Hannah Okroy, who's the manager for CE Special Risk Management at Atradius, a position where she's been for over 2 decades. Hannah is a graduate of the Warsaw University and Warsaw School of Business, a very distinguished institution. I know because I had classmates from there. Then I'm joined by Effie van Kraayen from Bureau van Beek, Moody's company. I like also to emphasize anybody in the room who haven't used Orbis before, you won't believe that, but Effie, we both started our career at the very, very beginning at the same Big Four company. Just Effie, you won't believe this, started there 12 years after me. Then Fabio, Fabio Lazzarini, who's International Development B2B Services Senior Director with CRIF, again, a position where he has been for over 2 decades, including other assignments within the group company. I guess I don't need to introduce CRIF too much. Fabio is a graduate of the University of Bologna and Politecnico Milano. And last but not least, I had to put some hierarchy into this introduction. Marcus Kuger, who's, again, when we speak about omnipresent, you all represent the companies which with products that are omnipresent or ubiquitous. So Marcus Kuger is a chief economic advisor for Baker ING. Before that, he had a long, distinguished career with Dun & Bradstreet. Again, one of those databases that you all are aware of, and he's graduate of the Julius Maximilian University of Würzburg, which is in Bavaria. I apologize, I'm obsessed with the education, so that's why I introduced you also with this education. So, speaking of reading the crystal ball, we could sit here with this 4 distinguished panelists for the rest of the day, which Mark wouldn't allow us. So we had to boil down in our discussions before we actually convened here to 3 points. The current macroeconomic situation with regards to what central banks are doing or are not doing, the supply chain topic, something that is very much out of the whole universe of macroeconomic indicators, something that's very much relevant for you, and the geopolitical situation, something which, yeah, if you turn on the TV, you can't really escape nowadays. American interest rates are starting to go down, but actually when you look at what macroeconomic models are showing you, they should have already been much more lower. But that's the same thing as something that Marcus has mentioned yesterday. For a long period, according to the macroeconomic models, the interest rates in US dollars should have been much higher than they have been. And that created this, over a decade period, when it appeared that money is for free, which is not. The ECB also ended this decade of free money, or actually the negative money when you look at the deposit rate, after the Ukraine invasion, so to speak, which according to some critics was too little too late. And now there are other critics who say that this starting campaign of cutting interest rates is also a bit too late. And the reason for that is that actually we already have the inflation under the 2% inflation target of the European Central Bank. So the obvious question should be, are the macroeconomists teaching you nonsense when they say that the job of the central bank is to maintain the inflation around the inflation target? Or maybe are these both central banks, as I've mentioned, a bit, as we like to say, behind the curve, just lagging behind? I'm just setting the tone for our discussion, setting the tone for some of the key topics that we would like to discuss. Marcus has mentioned yesterday about this long period of pretty much free money. This green rectangle is where, theoretically and according to its mandate, the ECB claims it wants to have the interest rates somewhere around 2%, which only happened for a brief period between 2001 and 2004. Actually, for 15 years, the average interest rate on euros, and that's why, let's discuss that, was 0.15% actually. So pretty much free money. When it comes to the reason why I float the idea, if the ECB is too little too late, and let's discuss that, part of the reason is that the Purchasing Manager Index, that's again the macroeconomic statistics based on the knowledge of people like you, the logistic managers who are every month asked, do you prepare your company for growth, decline, or for stable situation? Effectively, this indicator has been relatively reliable in suggesting what the future brings. And this indicator actually nowadays in September has dipped under the 50 points. So it says majority of purchasing managers are saying we prepare our companies for a recession. We could boil down. Yep. This reflects the fact that the biggest economies are Germany, France, and Italy are below this 50 level of distinguishing the expansion and a recession for quite a while. Just one blip from what we need to talk, especially here in Central and Eastern Europe, because for Poland, Hungary, Czech Republic, Slovakia, in this order, over 1/5, in the case of Czech Republic, over 1/3 of our exports go to Germany. German industrial orders, or factory orders, have recorded one of the worst outturns since 2020, since the COVID crisis. So yeah, just again, setting the scene for our discussion. Supply chain, something we all remember COVID, or I'm afraid to say we all very quickly forgot what has happened during the pandemics. One additional crisis that was like a chain follow-up to the COVID pandemics was the supply chain crisis. And then after it went away in 2022, and then the war in Ukraine started, we maybe thought this was transitory, this was just something temporary, and we will not ever have to deal with these supply chain issues. As luck would have it, one of the important topics for you this year was that the supply chain crisis did come back. And this is just one of the indicators, the container freight prices, which tripled pretty much from the end of the last year to mid of this year. This brings the question, is recurring supply chain crisis something we have to learn to live with? And what does it mean for the topics of nearshoring or friendshoring, or actually just, should we forget about offshoring at all? It's just a different picture of that. And last but not least, geopolitics. Yeah, a friend of mine, what I like, and that's why I appreciate we have Markus on the panel, is what I appreciate about Germans, and Austrians likewise, is when you talk with them about what has happened, they really literally tell you, oh, this was a short period, only 200 years, which is something we should appreciate in the knowing whom to trust industry. When we perceive the news every evening, we had this discussion in Budapest 2 years ago when the Ukraine war started. This is an indicator put together by two Italian academics who deal with geopolitical risk, and they try to put it into one index. And basically they show, yes, the start of the Ukraine war was as bad as World War I and World War II. And here we can discuss with our panel this Israeli-Hamas conflict. They only rank somewhere, it's bad, but somewhere around the Korean War, Cuban Missile Crisis. So with these three overreaching topics, I would like to hand over to my distinguished panelists, starting with Hannah, I would say, just because in my hierarchy, or my background analysis shows that you are the most senior on the panel. So I would like to hear your opinion. To this question, you can pick any of those. Are central banks currently behind the curve? And should we expect more significant cutting of the interest rates? Is the supply chain crisis something that will continue to reverberate across the not only European economy? And third, what might the current geopolitical risk, which some say might trigger a nuclear war, not because of the Russians, but because of Iran-Israel tensions, what does that mean or could mean for the people in the credit industry? The floor is yours.
Okay, thank you. I don't think I would add more on the theory of macroeconomy, as you have summarized that all very well. The question for me would be that we could discuss why the subjects should be on our list of daily checks of news as the trade credit managers. I think this is the point, because at some time when we just sit, or our teams sit at their laptops or computers or whatever, I mean, why should they bother about the crisis in Middle East, about supply chain crisis, or if the central banks are doing what they are supposed to do, or what the macroeconomists from universities think central banks should do. So I think the key point is the first slides that for many years, for the last 15 years, the cost of capital was next to nothing. So if we think of any experienced CFO, actually, but not only CFO, but the whole management board, actually to include this financial costs indicator in all management decisions of the production, of the trade credit collections, whatever, that it has now become the most significant factor we should all focus. And what also I would add about this financial costs, we have been here been showing the Fed interest rates, European Bank interest rates. There in the CE region, it's very important to remember there is Eurozone and non-Eurozone. And as we see, ECB has just decreased the interest rate to 3.64, I think. But then if we look at the Romanian interest rate, I think it's 8. In Poland, it's a little bit less than 7. So there is a huge difference in the financial costs simply within CEE in non-Eurozone countries. What is adding to this risk also is the exchange rates. Simple, the Middle East crisis now is weakening the currencies that are not euros in our region. And obviously for exporters, it's a huge gain. On the other hand, our economies are also based on import, and that's also adding to volatility risk that should be considered. So if we are talking now as trade credit managers, why we should consider that? It's because the financial costs and different financial risks are the basis of how our companies will perform, what would be the KPIs, maybe also how our bonuses would be. So I think looking at all of this, I would simply observe what central banks are doing, but also understand how the region we are operating in is doing and what are the risks. And even if it's CE, again, Middle East crisis is impacting and changing the risk profile we are working in.
Just a short follow-up question to you. Coming from the biggest and the fastest growing economy of the CE, let's put it this way, Poland actually in GDP per capita in purchasing power parity has almost catched up with Japan, something that would be unimaginable 30 years ago. How do you, when you properly said, when you see in the news that the geopolitical risk is going up, which typically weakens the emerging currencies, how much attention do you pay also to what the ECB is doing in Frankfurt, something that we'll discuss with Fabio and Marcus, because purely theoretically, this increasing interest rate differential should be keeping our Eastern European currencies in a stable territory, which doesn't always hold. Yeah. How do you compare this geopolitical risk versus the theory about the interest rate differential, which should actually be strengthening our currencies?
So obviously, looking globally at CE, including Poland, the geopolitical risk is something that investors look at, or now the algorithms, whatever AI is behind that. So if there is an investor thinking about putting new, whether it's a factory or simply buying some bonds, Poland being the front country now with the country in war, it's not the best option, being honest. On the other hand, and I think it's all for the CE countries, apart from external geopolitical risk, there is huge internal political tensions in all of our countries. And it's actually true not only for CE, but also any state looking at the USA elections coming, that also has influence of what will happen here. But coming back to your question, so there are geopolitical tensions from external, but also internal, coming also from some different impacts or influences from different other countries. So, in general, looking at the Polish economy, it's internally driven by strong internal demand, both from consumers and from local entrepreneurs, but still the impact of what is going on in the both European zone or the USA has impact on our future.
And in Germany, we'll come back to that FES. So out of these three topics, I maybe would challenge you most on the third one, because of your background and background of the Moody's company, Bureau van Break. So how do you assess the current geopolitical and other security risks as they pertain to the credit managers?
I'm going to part that question because I was actually piggybacking on what Hannah was saying. Why should you care about topics such as, for example, the supply chain crisis, right? Or supply chain in general. And I think, and there's a lot to unpack there, so I'm going to try to structure my answer in a concise way, but I mean, it's something which is touching all the companies and all the departments with all the companies, right? I think it's not okay just to say this is the responsibility of a trade credit department, this is the responsibility of, for example, a supply chain or procurement department. Looking at the supply chain risk is it possible maybe to have the slides with the, I think it was this one. Just to pick out a couple of things. So for example, if we take 2021, I don't even remember, for example, also when we had the Suez Canal. Was that in 2021 as well? Yeah, right. So
that was this period of chain crisis.
Yeah, exactly. So we had the increase in the costs. I think at some point containers were like 10 times the price.
Yeah, 10 times.
In some cases, exactly. So that's a significant, let's say, additional pressure on companies, right? And at some point, those costs will reflect somewhere. So it's looking at a company if, for example, this is their financial situation at the time. However, if indeed they occur with these costs at the same time, we had an energy crisis. At the same time, we had a crisis where certain goods couldn't be delivered, whether it was through the shipments or it was because we had, for example, the shortage in the chips. Okay, we now have the CHIPS Act in the US, but still that's not something that will happen overnight. So it's really adding up to all these things that a company which is performing very well, that all of a sudden could give a completely different outlook. And we don't have any, we can't steer this in any way, right? It took one ship in the Suez Canal, and I don't remember for how long, this had an effect, but it was major. Supply chain as well, just in general, you mentioned about the nearshoring, the friendshoring, etc. That all sounds really good. Again, the CHIPS Act in the US is one of those examples. However, this is, again, not something which will happen overnight. You cannot just say, okay, we're going to build our own factory to produce semiconductors, etc. That is extremely costly, of course. There is a reason why we're outsourcing certain production facilities, etc., to a different country. It's not because we like exotic destinations. It's obviously related to cost. So if all of a sudden we're going to bring those factories near us in areas that are a lot more expensive, again, that is putting a lot of pressure on companies which we don't foresee. There is a lot of focus now as well with supply chain prices, etc., to focus more on can we automate, can we digitalize stuff? But that brings us then, for example, into the cyber attacks. Just this morning I read an article that apparently the port of Zeebrugge, I'm from Belgium, was let's say, the victim of a cyber attack. I don't need to explain the importance of a port in the overall, supply chain and delivery of goods, etc., being able to sell. So there are so many things at the moment that are happening that, as I think you mentioned it, or you mentioned it, that in the morning, yes, you should care about all of them because there are literally so many events happening. It's so difficult. Luckily, we have AI to basically cancel a bit of the noise and to know where we should focus on. But there is so much to unpack lately. And if I may make one comment, on Moody's website, we have a brochure which is called The Era of Exponential Risk, where basically we say it's not just looking at one event, but it's really, if you add all the events, what is basically your breaking point, right? So yeah, to the question of Hannah, why should you care? Because everything will affect at some point your customers, the way that they will pay you or have the ability to pay you. Climate risk is another one, of course, not just within supply chain, but again, affecting everything, where we now see, for example, hurricane, I think the last one is Milton, if I'm not mistaken. Again, that will have an impact on our supply chain as well. If your companies are in an area where you're prone to those climate events, and a production facility is going down, hence it will have an impact on your supply chain. If your customer can't sell his goods because the entire factory is destroyed, inevitably that will have an effect on your company, on your cash flow, which then adds to indeed the increased cost of capital. So there is a sequence, there is a snowball effect. Is it a snowball effect, a butterfly effect? I don't know which, either of the two, but yeah, up to Hannah's point, yes, everyone should care.
Hold on, I have one follow-up question. I would like to encourage all of you to type in this app the questions that you might have, because we would like to hear what are the topics that interest you. This, again, is just our distillation. But before I hand over to Fabio, who's really a good insider, an important insider when it comes to the ECB policy, because of the role of the... back to you, Effie. Speaking of the ports, and speaking of the climate risks, how do you, again, as a Moody's Bureau Van Break, read, and to what extent should credit managers take seriously the ultimate ownerships of the companies who come to invest in Europe? Now I'm directly referring to the fact that a lot of our ports are being majority controlled by Chinese companies. And I'm directly referring to part of the reason why we had this energy crisis in 2022-23 was because the major supplier of our gas was also coincidentally owning a lot of our gas storages, and we pretended it doesn't matter.
And we've seen it doesn't matter, right? No, I think, obviously, indeed, with what happened with Russia and the gas crisis, I think we now understood, and especially talking from out of Europe, yes, we took necessary measures, whether it was making sure that people will now be investing in heat pumps, that we are relying more on electricity. I have a topic on that as well. At the same time, you make a very good point. I'll first of all talk about the topic, otherwise I'll forget. Again, it's one thing that we rely more on electricity and everyone needs to now install heat pumps, and we rely on the solar panels and renewable energy. But then again, that brings us to cyber risk. We discussed it yesterday. If you look only, I think it was in 2021, 2022, how many attacks there were on the satellites that are basically providing the communication channels for those renewable energy parks. Like in Germany, you had one of the biggest parks, I think it was called Nordex and Vestas, etc. If all of a sudden that shuts down, that obviously brings a lot of pressure on households, companies, etc., etc. To come back on your point about ownership, that's a very important point. And we've actually done a study some time ago where if you see indeed how much influence there is already from the Chinese government in strategic companies, for example, indeed surrounding the ports, that's a big thing. I mean, of course, why would a Chinese government be interested in mainly, obviously, utility companies as well, but also indeed the strategic companies surrounding the port, that if something were to happen with those companies, that would have a major impact again on the supply chain, etc. And, you know, I explained about that before. So it's one of those things that we need to look at. It's not just about looking at a customer as it is. It's understanding, is that customer part of a bigger network? Who owns that company, not just from a direct parent, but also looking on an aggregated one? It's something we tend to do more and more, really to zoom out and not just look at a company, maybe just the ownership, but also checking how our company is also related. If you have a portfolio of 100,000 companies, do you really understand, especially if you're working with different regions? So imagine you have a shared service center here, you may have one in APAC, you may have one in the Americas. is all the information being shared? Do you know if maybe 20,000 of your customers are somehow related to the other ones? If so, who is owning those companies? What is your exposure at some point? It's not just about group exposure, but also how are you exposed maybe to Chinese influence? Talk also about the geopolitical point. Obviously, we have one of the most important elections coming up. We don't have a crystal ball. The only two we knew this year as the outcome was the Russian election and was the North Korean one. Apart from that, sorry, it's a bad joke. Apart from that, it's going to have a major impact, right? If it's going to be Trump, what is he going to do with the two wars going on? Is it going to be Kamala? Yeah. Also from a US point of view, make America great again, all fine, but we already discussed that you can't change something overnight. Yes, you can say we are going to bring every production facility back to America, but how much time would that take? How much money would that cost? And at some point, people seem to forget that you need to pay that money back. Belgium is a very bad example into that if you look in how we are doing. So yeah, there's a lot to unpack there.
It's complicated. Speaking of Dunning-Kruger effect, yeah, Effie is so insightful that she doesn't believe she knows everything. She's on the other side, experienced enough to say things are complicated. Again, encouragement to write your questions into the app. Little theoretical window before I hand over to Fabio, because he's not only very experienced and has a background with very important intelligence provider, let's put it this way. He's also coming from Italy, which has entrusted us in the European Union with two former Prime Ministers, Enrico Letta and Mario Draghi, who just in the span of half a year basically summed up a lot of the topics, emphasizing why European Union is a difficult place or is a place where we are lagging behind. So I hand over to you if you want to touch these three major topics or other topics that you consider are important when it comes to crystal ball reading.
Yeah. So first of all, in Italy we usually export brain, so Mario Draghi, we keep, let's say, the worst people inside. I think one topic that we have not touched that is linked to all you said before is the impact of all of this to SMEs, because SMEs, not only in Europe, are really the cornerstone of trade and economy. So we saw the interest rate. I think that almost in every country, in Italy a lot, there was a lot of, not noise, but discussion over the news about the impact on the mortgages. I give you my basic experience. My mortgage, luckily my bank was not so bad, but my mortgage rate increased 60% in 1 year. But no one is talking about OECD, I think is almost unknown paper, the impact of interest rate, but also of lending policies to SMEs. For SMEs, it's becoming more and more difficult and costly to have access to credit. A lot of regulation that are coming in Europe, ESG is one of them, are really creating burden to SMEs. I'm not against ESG, I'm not against regulation. In my opinion, also, let's say, quite clever. The problem is then the implementation, because an SME is small. So we cannot think that she's able to handle everything, that they have a professional, and also all the, let's say, recovery situation that we are creating, like CSRD. So at the beginning was almost every company in Europe have to comply. Then probably 1,000 companies all over Europe. Is what we were saying before. We are still used to think in a linear way in our job, in your job. So you have a customer, you have a supplier, I'm evaluating this customer, this supplier. I'm simplifying a little bit, basically checking the balance sheet. Balance sheet is really the gospel. If something is written there, is the truth. Now we really need to understand the network. It's really a more holistic, in which financial risk is important, but all the other risks that we can call operational are important, but also the relationship of my counterpart with his counterpart is crucial. I give you a real example. I've got a customer, he's a German company, really, really large German company. Their procurement office is based in Hong Kong, simply because 95% of their suppliers are in Asia. And they discover that more or less 70% of their suppliers are not producing anything. So they are buying something to someone that is only a trading company. So in some cases, they own the factory, that in many cases is in Vietnam or in Indonesia. In other cases, they don't even own the factory. So all their supply chain was effectively unknown to them. Because this company were a good company, but it was the Christmas tree example. They were buying all the Christmas tree from one supplier with one factory in Vietnam. If something goes wrong, so no major, it means not having, is a retail, of course, you can understand, the company, not having the Christmas tree for the winter campaign. So it's a disaster from an economical term, it's a disaster from a reputational term. And they were not really having a clue about the owner, how was going this company, whatever. So I think that really having more insight on SMEs and changing the perspective, so really having a more holistic approach is the key of the future, because what you were saying at the beginning, what Mark said yesterday, I started working in 2000, exactly in 2000. So I lived in a world in which globalization was the normality. So it was not strange to have a customer saying, okay, we are producing one piece of this product in China, then we assemble in Algeria, then we finally put a made in Germany label in Germany, and then we sell to Italy. Or the cost of money was zero. When I started working, was feeling stupid not buying a house in Italy, because basically we are giving you for free. Now, we came back to normality, because what we lived in the last 10 years was not the normality, this is the normality. And we really need to go back, from a certain point, to go back to the basic, from another point, really, thanks to the technology yesterday, we had a lot of examples, really changing the way we are doing our basic job.
Mm-hmm. Thank you, Fabio. Again, I want to encourage you to write the questions that you might have, which we want to answer. In Central Europe, Fabio, when it comes to SMEs, and Hannah, correct me if I'm wrong, we say Mittelstand, by which I hand over to Marcus, who brings to us not only his long distinguished career from London, but he's the one who actually sits closest to the Frankfurt, by which I'm trying to navigate you to this crystal ball question, is ECB too little too late, or can we expect the euro interest rates to drop back where they were 4 years ago, or your thoughts on these three major topics?
So like you, I'm a macroeconomist by training, but I've worked for Dun & Bradstreet for many years and did a lot of work with industry bodies like CICM and FIBIS and AICDP, and now I work for a global debt collection agency. So the credit management part has always played an important role in my professional life. And one of the questions I always get at these events is where interest rates going, because I need to remortgage my house. So I believe, and I'm not alone in that view, markets expect the same, that interest rates will continue to come down in the Eurozone. Not only there, the Bank of England is also expected to cut rates further. And I think it's fair to assume that they will be cut at least one more time, but before the end of the year. The question whether they will drop back to zero, I don't think that will happen anytime soon. And I think we shouldn't lose focus that interest rates aren't the only important factor here. You've already mentioned lending terms. lending conditions have tightened. When we look at the bank lending survey the ECB is publishing on a quarterly basis, we see that getting access to credit is increasingly problematic for the corporate sector, much more difficult than a few years ago. And even if interest rates go down, we have to keep in mind that we've seen the chart, they were virtually zero for such a long period. So if they're going down by another 25 basis points, 50 basis points, I think that isn't really important for a company that is rolling over debt that they've taken out 5 years ago, 7 years ago, because then they virtually paid no interest, and now, yes, they will pay a little less than they would have paid a year ago or 1.5 years ago, but I don't think that will be a game changer. And we're actually seeing that when we look at insolvency rates at the moment. Insolvency figures are still rising despite the cuts that have already been implemented. So that idea that interest rates will go down and the problem of massive insolvency figures will disappear, I think that is way too optimistic. This morning I looked up insolvency statistics for a few countries. In Japan, it's actually on the highest reading since 2013. In the US, it's on the highest reading since 2020. In Germany, figures are still rising. In France is a complete basket case at the moment from a credit risk perspective. That's at least according to data from my previous employer, Dun & Bradstreet. They publish payments performance data, and France is now, it's only a small sample, I think it's 9 countries. But when I started at DNB, which was in 2010, France was a country with a very good payments performance. Not as good as the Netherlands and Germany, they're always leading the table, but France wasn't far behind. And over the past 2 to 3 years, France has slipped. The average payment delay in France now isn't far off from Italy. The worst performer is Portugal, by the way, but France is increasingly problematic from a payments perspective. And I said I work for Baker Ring now, a debt collection agency, and our data shows that a lot of French clients aren't paying on time or aren't paying at all anymore. So it's not only Germany that is struggling at the moment. It's certainly an interesting time to work in credit, and although the economy has switched into a higher gear in some economies, I think there are still a lot of problems coming out of the economy. Inflation has come down, and yes, growth will accelerate probably compared against last year from a Eurozone angle, but even with that improved outlook, we are still in an environment where growth is fairly low, at least when we compare it with the long-term average.
That was very good summary of the discussion that we basically had, and a very good reflection upon the conclusions of the former Prime Minister Letta and Draghi, that the problems in the Eurozone economy can't be solved just by the central bank alone. That I would just summarize, and that's something reflecting upon the Mark's initial presentation, that we got to learn to live with the higher nominal interest rates. I would like to ask Esther if she has questions in the application, to read them out for us. I don't see her at this moment. I would like to reflect again. We are going into, we all agree, into a difficult period, let's put it this way. In many economies, the difficult period has actually already started, but again, I would like to bring in this third topic of the geopolitical risks. How do you, all four of you, starting with Hannah, read this increase of the geopolitical risks, and to what extent should the credit managers pay attention to, I'll paraphrase Effie, to corrosive capital, the investors whom we considered perfectly legitimate, good, honest investors, who now it seems might have presumed economic interest, which they eventually want to turn into a political influence after getting the economic influence. So to what extent do you think this is something that we need to pay attention to? In other words, should we put more effort into the screening of our counterparties and our potential investors?
Of course, we should put more attention to that. So I think there are some currently famous books. The motto is "Be prepared for the worst, but hope for the best." That's something we should just think in our everyday job. Screen the portfolio of our customers, of our partners, to be aware, simply to build awareness within the managing team, but also the teams that are next to the partners, customers, to make sure we understand the risk profile we are working with. Whether it's geopolitical event, whether it's the supply chain, whether it's the financial costs, just risk management, it's something that will simply pay off and really think out of the box because like it's not only about how Europe has managed the gas and fuel supply, that either we have not been that aware or some of us were more aware. But there are events that will happen, black swans that will happen, and we just need to be prepared, become flexible, understanding the risk profile we are working with. That would be my advice.
Poland is actually one of those countries that has been very precautious. You are very good credit managers when it comes to this external influence. But for example, in Hungary, 44% of all Chinese FDI into European Union sits in Hungary. How would you as a credit manager look at your counterparty of varied ownership coming from Hungary?
I cannot comment specifically on Hungary about Poland being overcautious. Interestingly, after the Russian attack of Ukraine, we've been making reviews on how much economies are dependent on Russian banking system. And actually it was a huge surprise to us, maybe not directly in Poland, but of our headquarters, that there were practically no Russian banks registered in Poland. The question, comparing to Austrian, Hungarian, Romanian, maybe Romanian less, but mostly Austrian and Hungarian exposure, also the companies being reliable and having their main bank accounts with Russian banks. So how to put it into perspective, also what financial institutions you choose, and how to also differentiate also the political or geopolitical background of your not only customers, buyers, but also the financial institution. So that's interesting one as well.
As I warned at the very beginning, I believe with this panel of distinguished speakers, I could carry on this discussion for the whole day. Unfortunately, Mark wouldn't allow me. So I would like to ask just a closing comment, a brief closing comment, if I may ask you, Effie, Fabio, and Marcus, when it comes to should a word corrosive capital be something that credit managers should take out of this whole scope of the macroeconomic universe topics and pay more attention to come in the upcoming years? Again, and that's something that, as Fabio has mentioned, 5 years ago, as we are speaking here, 2019, nobody would ever take this as a topic at all.
I was just also going to comment on something else. Sorry. No, but it was a very good point that Hannah made about, indeed, it's one thing to put more emphasis on the checking of the counterparts, but I think also up to Marcus's point about also looking at what a country overall is doing. We'd like to be as predictive and as forward-looking as possible, of course, so it's not just about checking counterparts, checking the overall portfolio, but it's indeed closely monitoring what is a country doing, what is a specific sector doing, what is the outlook. We even go as far as, maybe not for the entire portfolio, but really to check, like the stress testing that you do, we typically see in banks. If you have a huge exposure to certain counterparts, that you do a sort of scenario check where if you see that the outcome would be negative, let's do this stress test. How would this company perform under different circumstances? Instead of waiting for something to happen, because we know it will happen. Something will happen. We don't know yet, but it will. We listed a bunch of risks, and again, it's if all those risks compile, what is basically the breaking point? Instead of waiting for the breaking point to happen, let's make sure that we can hopefully predict. Again, no crystal balls, but we try to be as close to that as possible to make sure that you can account for, anything that would happen, that you know where you would be, that you can take the necessary measures, that you can basically mitigate the risk that eventually probably will happen in the future.
Mm-hmm.
That was my takeaway.
Very good, very good. Effie, thank you very much. Again, Fabio, just focusing out of the whole universe of the topics that we would love to discuss here, but we are not allowed because of the time pressure. Reflecting also upon the tools that your company is providing, should corrosive capital be something that is a topic for the credit manager nowadays?
Sure. And let's say, we already touched, I think, all the important topics. So I totally agree that we need to move to a really more portfolio view of our customer, not anymore a purely transactional. And probably, and of course, correct me if I'm wrong, because you are the professional, I think also the job of credit manager, at least in large organization, is really moving to a risk management position, not only a credit management position. So also the way in which we are evaluating counterparty is really more a due diligence process rather than a pure, say, tactical, I'm stressing, so please apologize me, administrative job. So I'm only checking if this customer is viable, is able to pay my invoice, that's done. In terms of also capabilities, let's say, geopolitical risk, macroeconomic risk is now part of the equation. So one question that you raised at the beginning, and we need an answer also because I think there is not an answer, so which is the impact of Israel-Iran war. We have seen it in the rate of freight cost. Let's say instability in the Gulf, at least until the North Pole will completely melt, is crucial for our transportation. So if there is a crisis there, it means that the cost will raise, you will have disruption, and you will have impact. Let's say Ducati Motors in 2021 had a huge impact in cash flow simply because of the Suez crisis, because don't ask me why. I'm living in Bologna, so I live nearby the factory. In Malaysia, there are a lot of Ducati customers, so they love Ducati. So there were 2 ships full of containers of Ducati stopped in the Suez Canal, waiting for customer, waiting to be paid. So it was end of the year, and this money didn't enter, and it was planned. So really, we really need to pay more attention of what's happening, and I totally agree, we should start running scenario analysis. So what could happen to me if something happened?
Mm-hmm. Thank you very much, Fabio. You notice he tried to start me on another multi-hour discussion about what would happen if Strait of Taiwan would be a subject of the war. We don't have time to discuss that, but Marcus, as you are the one closest to where the most important macroeconomic decisions are being made, the Frankfurt that is, what is your closing takeaway from the viewpoint of Frankfurt, something that we should and must in Central Europe pay close attention to?
So you mentioned the potential conflict in Taiwan, and I know that Bloomberg Economics has recently published a study where they basically tried to quantify the potential costs, and they basically said if there's a war that would involve the US and China and inevitably other parties, it wouldn't escalate to a nuclear war in their scenario, and the cost would amount to 10% of global GDP. And just to put that in perspective, COVID was 6%. So that's quite scary. But I want to finish on a high, which is very unusual for German, I guess. I'm involved in these kind of events on a fairly frequent basis. So I'd say every month, every other month, I'm sitting on a panel or I give a speech about macroeconomic conditions and geopolitical risks. And generally, of course, there are problems. We've seen the chart of geopolitical crisis, and yeah, they're there. There's no doubt about that. But when we look at the economy, things are looking a bit better than half a year ago. Inflation is back under control. The economy is accelerating, of course, accelerating from a very low base, but still things are looking better, the labor market is strong, and the world will continue turning. There are challenges, but there are a lot of companies out there that offer solutions to navigate these treacherous waters. And I think, things have improved over the past half a year, but then next month there are elections in the US, so if I was sitting here in December, maybe my optimism is gone.
Ladies and gentlemen, this was Hanna Okroy of Atradius, F.A. van Kraayen of Moody's, Fabio Lazzarini of CRIF, and Marcus Kuger of Baker ENG. Please join me in a round of applause for them. Thank you.
Thank you very much, everybody. That was great. If you just stay there for 1 second, we have a small gift for you. So, lads, if you just kindly take that. And now, in a second, we're going to take a break. We'll have a 20-minute break.
Thank you.
Okay, so refreshment time. Thanks again for a great session. See you back in 20 minutes. Thank you.
Thank you. This was a very good discussion. Thank you. Thank you. Thank you, Hanna. This was very.
Thank you.
Thank you, Marcus.
Thank you.
You very skillfully avoided me pushing.